Well, folks, we got our first set of bank earnings out and the market didn't like them. Bank of Nova Scotia, or as every normal person calls them, Scotiabank, has released their fourth quarter results, and the market responded by selling off the stock by about 3.5%. The gripe here appears to be slowing growth and impairments as a result of the slowdown in China, which is impacting the value of some of Scotia's investments. Folks, we're talking bank earnings, we're talking Q4 earnings, we're talking Scotiabank, we're talking the Canadian economy. Let's dive in. All right, let's start off with the high level. Scotiabank in the fourth quarter posted net income of $1.7 billion, or $1.22 a share, a 24.7% improvement on a year-over-year basis from $1.4 billion, or 99 cents a share in the fourth quarter of 2023. On an adjusted basis, net income came in at $2.1 billion, or $1.57 per share, versus $1.6 billion, or $1.23 per share in the year-ago period. Despite the improvement on a year-over-year basis, Scotiabank still failed to achieve analyst estimates, with analysts calling for EPS of $1.60 per share. This net income was off the back of $8.5 billion in revenue, a 3% improvement on a year-over-year basis. Revenue is broken down into two segments by the bank, with net interest income totaling $4.9 billion for the quarter, a 6% improvement versus the prior year, which was attributed to loan growth. The net interest margin stood flat at 2.15%. The other segment, non-interest income, declined by $3 million on a year-over-year basis, meaning it was basically flat at $3.6 billion. Adjusted non-interest income, however, grew by 11% to $3.6 billion, which was attributed to higher revenues from trading, higher fees, and wealth management revenues. Included in the quarterly results in Q4 were adjusting items of $430 million on an after-tax basis, which is predominantly attributed to a $379 million impairment on Scotiabank's investment in Bank of Jiangco Limited in China, a resulting of the slowing Chinese economy. Other impairments included impairments on certain software intangibles and $38 million in severance provisions. Return on equity, meanwhile, amounted to 8.3%, an improvement from 7% last year, which climbs to 10.6% on an adjusted basis. For the full fiscal year, the bank posted net income of $7.9 billion, or $5.87 a share, a 5.9% improvement on a year-over-year basis from $7.5 billion, or $5.72 a share in 2023. Adjusted net income rose less dramatically, at 3.2%. Climbing from $8.4 billion, or $6.48 a share, to $8.6 billion, or $6.47 on a per-share basis. Return on equity for the full fiscal year declined slightly on a year-over-year basis, falling from 10.3% to 10.2%, while adjusted return on equity fell from 11.6% to 11.3%. Scotiabank also finished the year with a reported Common Equity Tier 1 capital ratio of 13.1%, which is up from 13% in the year-ago period. All right, let's get a bit into the details here. Scotiabank breaks down their operation into four key segments: Canadian banking, international banking, global wealth management, and global banking and markets. Each segment is rather self-explanatory. The firm's Canadian banking segment, their largest segment by net income, in the fourth quarter saw adjusted earnings improve by 34%, jumping from $800 million to $1.1 billion on a year-over-year basis. The massive increase was attributed to lower provisions for credit losses and, well, higher revenue. And why did revenue improve? Asset and deposit growth. Fairly self-explanatory. The second largest segment, international banking, saw net income improve less dramatically, climbing 16% from $600 million to $700 million. The improvement here was attributed to higher non-interest income and lower non-interest expenses, which was partially offset by higher provisions for credit losses. Significant growth, meanwhile, was also seen in the global wealth management segment, which saw net income increase by 28%, climbing from $300 million to $400 million. Higher mutual fund fees and brokerage revenues were attributed to the improvement. Finally, growth was negative to the tune of 2.7% in the firm's global banking and market segment, which came in at $400 million. The lack of growth in the segment was blamed on lower net interest income and higher non-interest expenses. All right, let's get into the loss porn. Just kidding. Things actually appear to be semi-trending in the right direction, which is a good sign for Canadian consumers and the economy in general. Provisions for creditor losses declined by 18% on a year-over-year basis, falling from $1.3 billion to $1 billion. The provision for credit losses ratio, meanwhile, declined by 11 basis points to 54 basis points. Scotiabank actually saw a net reversal on credit losses on performing loans during the quarter, to the tune of $13 million, compared to taking provisions of $454 million in the year-ago period. The reversal is said to have been driven by retail credit migration to impaired, as well as interest rate cuts, which assisted mortgage and auto loan portfolios in Canada. Unfortunately, it's not all positive, however. Gross impaired loans as a percentage of loans and acceptances rose from 74 basis points to 88 on a year-over-year basis, with net impaired loans rising from 3.8 billion to 4.7. And on top of that, mortgages in arrears are trending in the wrong direction, as are credit card debts and lines of credit, at least in Canada. All right, so let's wrap it up. Scotiabank's results basically were a mixed bag. Net income improved, but not as much as analysts called for. And loss provisions are down, but impaired loans are still growing. As for growth, Scotiabank didn't set any hard targets for 2025. Here's what they said word for word. The bank expects solid earnings growth in 2025, benefiting from strong net interest income growth and higher net interest margin driven by lower funding costs and growth in both loans and deposits. Non-interest revenues are expected to grow more modestly. Nothing like setting clear targets, eh? Guys, I've always been critical of the Canadian banking sector because I feel like the banks here don't take on enough risk, and we pass that on to first-time home buyers via the insurance policies of the CHMC. Ultimately, if there is an economic crisis and we start to see mortgage defaults everywhere, we all know how that's going to end. It's not going to end badly for the big banks. It's going to end badly for the Canadian taxpayer, who's ultimately going to end up seeing those basically defaulted mortgages, those toxic assets, end up on the Bank of Canada's balance sheet. But I digress. The fact of the matter is that we're seeing some of those mortgages, credit cards, and operating lines of credit in arrears grow. And in my view, that really isn't a great sign for the Canadian economy. It just means that consumers are having a harder and harder time keeping up. And this is something we're going to want to watch and follow with all the big banks. And by the way, we're going to be bringing you guys coverage of all the earnings for all the big Canadian banks this earnings season. And you're going to be getting pretty much all of them this week. So if you are investing in Canadian banks and you want these breakdowns of earnings, you've come to the right place. Guys, this is our first time doing this, covering bank earnings. So let us know what you think in the comments section. What are we missing? What do you guys want us to talk about? We're here to serve you guys, our audience, and hopefully you guys find some value in these videos. And if you do me a favor, smash that like button, subscribe, and ring that notification bell. And also, guys, we appreciate any of the engagement we get in the comment section. Thanks for watching, everybody.